So the best thing to do is to be draining the assets down out of the plan, paying yourself first, and setting yourself up to be able to walk away with no pressure. Then you can sell it for whatever you feel like selling it, and you're not under any pressure to try to get it sold right away.
This is the Retire Happy podcast with John Iammarino, fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Rockaway, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I am your host on the West Coast, John Iammarino, and I am joined by my host on the East Coast, Tom O'Connell. Tommy, how you doing, buddy?
Hello, everybody. Doing great. How are you, John?
Doing good. Just came back from a spring break trip, so...
Same here. I was out in Cape Cod.
Very nice. Look at you. How was it?
It was nice. It was quiet because it's off season still, but my daughter and her friend really enjoyed it. We went to Martha's Vineyard for a day, and it was interesting.
Very nice. Yeah, we just drove up. We took the RV about 5 hours north to Bulletin, north of Santa Barbara. So camped for about 5 days. Wasn't bad outside of the drive through my favorite city known as Los Angeles. But other than that, it was good. And we got a big day tomorrow. Tom,
drive through or drive by?
No, there is no driving through. You're stuck in LA traffic. So before we start this podcast, want to say happy birthday to my darling little princess who will be 4 tomorrow, Haley.
Bailey, my buddy.
That's right. So, folks, we have another great episode for you today. If you are a high-income business owner or professional, such as a physician, attorney, or dentist, or you know one of those people, you're definitely going to want to listen today as we are bringing the CEO of Retirement Actuarial Services, Steve Arnold, onto the show to talk about some innovative tax-saving ideas and planning. And Tom and I met Steve. We've known Steve for a little bit, but he really brought this idea to us last year at a conference in Nashville where Steve was asked to talk as an expert speaker at a Brookstone conference. And it is a phenomenal planning idea for those high-income earners. And for those of you who always like to know about our guest, Steve Arnold is the CEO of Retirement Actuarial Services. He is an 18-year veteran of the financial industry, and he has a professional designation as a chartered retirement plan specialist. And he's educated in the specific area of small business design, implementation, and maintenance of retirement plans. And he and his firm do ongoing training for CPAs. So great guy, former Marine, so thank you for your service. So I would like to introduce to you the CEO of Retirement Actuarial Services, Stephen Arnold.
And introducing this week's guest, the CEO and founder of Retirement Actuarial Services, Steve Arnold.
Hey guys, how you doing?
Good, Steve. How are you?
I'm good.
Welcome to the show.
Thanks for having me.
So, Steve, you are the CEO of Retirement Actuarial Services, and you and your team came up with what you call the Designer 401k Plus program. Why don't you tell us what that is?
Well, the Designer 401k Plus program is basically a combination retirement plan that we customize. So it's basically a pension plan and a defined contribution plan mixed together. We're able to combine these plans in order to be able to get large tax deductions and savings from small business owners into the retirement plan, where it's a creditor protected method of accumulating at least $3 million in retirement accounts.
That's pretty significant for a business owner. How does it reduce the taxes?
So it reduces taxes by coming off the the gross of the company. So let's say you have $1 million that you have as a gross. We're able to, based on the age and the time to retirement and salary, we can come up with numbers that are usually in the hundreds of thousands of dollars. So let's say you have a year that you could put $400,000 into the plan. That reduces your gross from $1 million down to $600,000. So now it's much easier for your CPA to go from the $600,000 and do his magic and do his tax deductions, where he doesn't have to push any red flags by getting aggressive to get you to zero out your taxes.
So that's a little bit different than a more traditional approach, I guess, where typically you're taking it off of the employee's income versus the gross, I guess, revenue of the corporation.
Yeah, because the corporation is sponsoring the plan, they're able to take the tax deduction on the business side, and we do all the testing for the employees by being in the profit share side. Therefore, we're really actually not even doing a 401k. We're actually having the corporation do a contribution on behalf of them to the employee in the profit share.
Yeah, and Steve, I remember at the speech you gave, you were actually talking about how a lot of especially the professionals, the doctors or dentists, they would oftentimes look to buy that new big piece of equipment to earn that tax deduction. And now with this 401k plan and the tax reduction in it, they no longer have to do that. They can pay themselves first, correct?
Yeah, that's a great point. Because they can pay themselves first, they're able to take those, when they have good years, they have good cash flow, they're able to reduce their taxes by putting the money into their own pension account and their own creditor protected account for retirement, much more aggressive than a 401k, which most of the time is never going to be able to satisfy their salary in retirement because they're high income earners. So the 401k caps them. The actual plans that we do allow them to solve for 80% of their salary in retirement.
Right. Now, you brought up some numbers, and obviously, the SEP IRA and 401ks, they have the maximum contribution levels that are, just under $60,000 a year. What are the ranges of deductions and contributions allowable into this plan each year?
They're anywhere from $75,000 to all the way up to $1 million in a single year.
Wow. So you could shove up to $1 million. Now, once the plan is constructed, you're not obligated to put in a certain amount every year. There is flexibility, correct, based on how you perform that well or how your business performed that well?
Yes, older plans had restrictions where they were just defined benefit plans, and they were not very flexible, and they were using insurance products in order to get that large of a contribution. The new laws allow for the plans to be a combination using a cash balance plan. It leaves it very flexible to where you could actually almost go back to very minimal dollars or even freeze it in years that you don't have a cash flow. So instead of buying equipment just to take depreciation, you don't need it. You can put the money into your pension plan. On the years that you see an opportunity, maybe you want to buy a building or maybe you want to buy some equipment, then you can do that and you reduce the amount of money that you put into the pension plan.
So, Steve, you're talking about, it sounds like a couple of different or a few different moving parts within the design. So you've mentioned a 401k, a cash balance, profit sharing. Are there other components that business owner or owners could utilize within this plan?
Yes, one of the most important things I think is in retirement is the medical expenses. They are completely through the roof. Costs for long-term care. Most people can't even get long-term care insurance anymore. And we have what's called an aggregated benefits. It's an addendum that goes onto the pension plan. It's in our documents and allows you to take advantage of a code called 401H. And that is basically it's a medical fund, kind of just like an HSA, but much bigger, like on steroids. It's able to get up to $594,000 of money in there, where you're taking a tax deduction, growing it tax deferred, and taking it out without taxation for any medical expense post age 62.
So is that the maximum contribution in a year or over a period of time that someone could put into that?
That's total accumulation over time. So it'd be just for that person can get a bucket of up to $594,000 of their money that they put away into that, that can be utilized for that.
Not including any possible growth in that.
Well, you'll get growth. So each year you may be putting 20, 30, 40, 50, or 100,000 into that portion of the bucket. Then it gets its growth and it gets capped out at the 594.
I got you. Okay. Awesome. Well, that's something that a lot of people have no idea even exists these days.
True. A lot of people don't. And it can be used for dependents if they're on your tax return. If they're actually a dependent of yours, you could use it for your children or for your parents if they're actually a dependent for you. So it's very powerful because there's a lot of money that can be taken out of that for even elective surgeries. It doesn't have to just be, something in the hospital. It's pretty much any medical expense is a reimbursement.
Now, you also mentioned something about life insurance, which I think most people out there don't realize. You can have life insurance inside of a qualified plan, pension plan type of program. So how does that fall into this?
Well, yes, life insurance can be purchased inside the plan. The government set rules thinking it was a good social policy to be able to allow people to purchase life insurance to protect the family and protect their beneficiaries. And you're getting that on a tax deductible basis. So you're able to leverage that and actually have a tax-free retirement benefit go to the beneficiary. So it's really nice to be able to put that in there. There's several ways we can do that. We can design it where it has cash in there so that later on when we don't need the insurance anymore, we surrender the policy and the cash goes into the 401h medical bucket.
Talking about the power of that 401h medical bucket, I have a couple clients who had, their own personal pension plans, and I had talked to a couple of them about our program that you and your actuarial team have brought to the table. And I asked a couple of them, do you have this 401h bucket? Because I haven't seen anything like that in your pension plan. They said, no. What do you mean? I could have taken money out tax-free for my long-term care premiums and to pay for my Medicare. And I said, yes, under this design. And, the look on their face is like, man, I wish we had this design. And how often are you coming across where people have perhaps pension plans, but they just don't know about this powerful feature?
Almost all the time, even older plans. We do a lot of older plans and redo the plan and then bring it on so that they can still then start accumulating money in the 401h. It's really missed in the industry.
Wow. Yeah. Like so many things that, we come across, right, Tommy?
Absolutely. There's just an unbelievable amount of information that's not being given out to the public. And that's why we love having guests like Steve on our program. I mean, this isn't even, in our wheelhouse as experts. And that, again, for our audience, this is why we bring on the kinds of guests like Steve and the other guests that we've had in the past, because we're trying to create an atmosphere for our clients where it's a one-stop shop where they know they're going to get the experts in all the different areas.
Yeah, absolutely. Absolutely. So now we talked about the tax deduction savings, the 401h, the money that, goes in tax deferred and comes out tax-free through the 401h. But this program also offers some strong creditor protection, right, Steve?
Yeah, some of the best creditor protection because it's under the ERISA laws. And if you remember, O.J. Simpson still owes the Goldman family about $30 million and they can't collect it. He's out playing golf. He collects about $25,000 a month off his pension because he had it in one of these types of plans. And when he was doing Orenthal J Productions and the OJ and the Hertz Rent-A-Cars and all that, his accountant had him put all this money into these pension plans, and that's where he actually still has his money coming from, and why he doesn't have to pay out. So it's one of the strongest you can get.
Kenneth Lay from Enron also had the same type of program. So when Enron exploded or imploded, and all those executives were getting sued, basically the same thing happened to him. He was a Florida resident. He had all his money in his residence and these types of plans, and basically he was untouchable.
Yeah, it really is amazing because you have doctors, they're a walking target. Almost anybody's a walking target. If you make money these days, there's always a lawyer ready to get at you. And having this money in there and accumulating that money in there makes sure that nobody's going to be able to really get at you.
So one of the big questions we get when we're speaking with our clients about these types of plans is, hey, well, I have a CPA and I'm not looking to replace my CPA. And Steve, that's not what you're trying to do, right? I mean, you're you're really there to be a helping hand to the CPA and enhance their business, really, right?
Correct. We actually teach CPAs and actually are on board. And part of that is that we always want to talk to the CPA. The CPA is always welcome because we want his input. We all need to be on the same team. It's a big team collaborative approach. So we're going to find out what is the tax consequences? How much do we want to put in? We're tailor making a plan, and each year it changes. So we're going to be in constant contact with both the client and the CPA in order to make sure everybody's got this right.
So for any CPAs out there that are listening, or if any of our clients are working with the CPAs, tax season's over. This is the time of the year now to start taking a look at these things and setting them up for this calendar year and going forward. And then I guess really, Steve, I think John and I really should be talking to you at some point about you coming out to our different locations and us doing an education class for the local CPAs.
Yeah, we'd love to do it. And in fact, you could still actually do planning for 2021, because if any business has done an extension, they have up until their filing date to put a plan in place and contribute.
Great point.
Now, Steve, a lot of our listeners only know you as the CEO now of the Retirement Actuarial Services, but you're also a Brookstone advisor. And one thing that a lot of people have to understand about this plan is it's not by a fly by the seat of your pants plan. Everything is well thought out. You have an actuary on hand, and the investments have to go a certain way, more or less conservative investments to take advantage of the tax deductions. But can you talk to us about the complexities behind the scenes and where you really want a qualified team to take a CPA's client, or if you're a high income earner, take you through this process?
Yeah, so there's a lot involved. There's bookkeeping, there's record keeping, there's 5,500 filing, there's calculations each year that we have to do. So we do all of that, and we have the team in place to do that. The actuary has to certify the numbers in the plan each year. This is to keep compliance, to make sure that nothing is getting outside the law. Everything is black letter law. There's nothing, all these rules have been around for a long time. They're nothing new. They're just the 2006 Pension Protection Act made some changes that allow for the combination plans that are just much more advantageous for the small business owner.
Great.
And so I guess one of the big questions really, because there are most businesses, I guess, really are the smaller mom and pop kind of shops, the 1, 2, 3, 10 employee type of companies. So affordability wise, Steve, how does this fall for, or where is this going to fall on the spectrum of cost for our clients?
So cost is relevant to what you're getting, but the 2020 Secure Act made a big change. They know that small business companies have not been putting retirement plans out for their employees. So what they did was to incentivize that. It used to be a $1,500 tax credit that you would get to set up a plan. That was for your design, document fees, and that type of stuff. Now they've raised it to $16,500. So our design fee and everything that you go through to get the actuary work, to get a plan set up, to get your documents, to get everything set up, most of the time becomes a net zero cost, because you get an actual dollar for dollar tax credit for setting up a plan.
That's huge.
Absolutely. Now, for our listeners, and whether it's, like I said, CPA or high income earner, what is the typical plan that you see? Or if our listeners are saying, well, is this right for me? What is the ideal client that you guys plan for?
So we plan for just about everybody. Most people think they only have to be a doctor, a dentist, or anything. It's really a small business owner that has earned income. If you have that and you have a positive cash flow and you have a tax liability and you want to put over $60,000 away, because you can take care of that in other vehicles such as the SEP and those types of traditional vehicles. By doing this, you're able to radically increase the amount of money that and front load your pension plan or your retirement plan up front.
So you say, I guess, smaller businesses, but how about a company maybe with 50 or 100 employees? Is it something viable there? And then I guess part two of that question would be is, hey, could we go out to different HR organizations and show this to the HR departments and say, hey, maybe this makes sense for your company?
Sure. We have companies that have 150 employees, so it really just depends on the makeup. Some of them are seasonal, so they're not counted in. And so we're going to really work the numbers over, make sure it's compliant, but it's always good to look at it. It can be hundreds of employees.
Right. Well, that's a very powerful thing to be able to offer, today's business owner, especially, with all the taxes and whatnot we face. Now, getting back to the limits and the 401h, I know a lot of small business owners that are really family affairs. So, perhaps the spouse may be involved in the management of the office or whatnot. How does this plan, let's say you have a husband and wife team, are they limited to that $594,000 total, or is that per individual?
No, it's per individual. So the husband and wife both can accumulate $594,000 each, ranging over $1 million.
That's
wow.
huge.
Yeah.
That's huge.
I mean, if you really look at that, Tommy, let's say, and at what age can you start using that $594,000?
Age 62.
So, I mean, I have a lot of clients that were dentists, or attorney, or small business owners, and they worked until their late 60s, maybe even 70, because they loved what they're doing. But imagine, Tommy, you're 62 and you're trying to take care of your long-term care. You still have your medical costs for insurance or now Medicare, and now all that's being paid for with tax-free dollars.
Just imagine the step up in lifestyle that you'll be able to accustom yourself to.
Right.
It's huge. I'm making light of it a little bit, but if you're not paying $50,000, $60,000, $70,000 a year for, look, a family plan life insurance policy, not life insurance, health insurance, right, is running $24,000 to $30,000 a year. So imagine that's $3,000 a month or $2,000 a month now that you don't have to pay in retirement. That's huge.
Yeah. And even if you're on Medicare, let's say you're spending, after if you have a Medicare supplement or Medigap type of plan, perhaps, the spouses, you're paying about $600 a month, right? Estimated after Part D and whatnot, that's, $7,200 a year. And then let's say you have another $10,000 or more of long-term care premiums on top of that. You're looking at, close to $20,000 of taxable income that is now been made tax-free.
What about if you have something where there's an experimental surgery or experimental drug or something else that the insurance won't help you out with or anything like that? You can still reach in here and grab this money and use it how you see fit. Wow.
Now, can you expand on that a little bit in terms of the experimental? How would you present that? If you were accessing the money and the IRS was to kind of question that.
Yeah. So you keep the receipts of your actual transaction, and then it's in a reimbursement. So it's submitted to the company, which then we're on behalf of the company, we are doing the admin services. We reimburse from the plan the money that was used for that expense.
And then you square that up when it comes reporting time.
Correct.
Wow. So what is the limit though? So, someone who really likes this program, really wants to get aggressive with it, you can only put up to about $3 million though in this plan, correct?
Yeah. So the plans are solving for just around 3.3 million adjusted for inflation. That's basically what it's doing is it's replacing 80% of the participant's salary up to a maximum. So you have, say, a $250,000 salary. We're solving each year to put in 80% of that salary so that when he turns age 62, he can take out that same 80% of his salary for the rest of his life. That's the defining benefit part.
Wow.
So it's like the pensions, in the old days, what they would do is they would take that money, they'd solve for X amount of dollars. Then they would either turn it over to an insurance company and get an annuity so that you gave them the risk of longevity. So if you lasted to age 101, that same payment had to come in. In this case today, you don't have to give it to an insurance company. You could take that whole $3 million and roll it into another qualified account and still manage it the way you want. And you could grow it even further than that. So if you fill the bucket up and you're not tapping it, you could still grow it to $5 or $6 million once it's outside of the pension plan, because we're no longer using actuarial assumptions. But it's basically replacing the salary.
Right. Yeah. And we've had that in the past where we've had some clients, it was brought down right to the point of where they're retiring. They're at their $3 million cap, and we rolled it over into an IRA and continue to grow that money from there. Now, when we're looking at this, how long, let's say, I have a listener and they're only going to be, maybe they're in their late 50s or early 60s, and they're only going to plan on working maybe less than 5 years. What's the most aggressive you've seen, or what are the timelines that you usually plan for?
So the timeline, you're supposed to enter into these plans with at least a 3-year window. So you want to have the plan in place 3 years or more. That doesn't mean that you have to. I mean, there's things that happen. Obviously, if something happened to the business and it went under or something like that, you wouldn't be held to the 3 years. But that's kind of the guideline of how long you're supposed to be in the plan. It can be very aggressive because depending on your salary, you now have catch up. So to replace that salary, if there's large cash flow, you're going to have some really high numbers, 400,000 or 500,000 if you're, in your late 50s or 60s, to catch up to make sure that money is there.
Right. So after you get past all those, those medical loans and all that you had to repay off, now you're focusing on your retirement. You might be a little bit later in your career. You still have plenty of opportunity to build yourself a phenomenal retirement plan.
That's correct. And we have a lot of people that do that. They start to make their money later in their career. Things are more paid off. They've got cash flow, and now they don't want to pay taxes. And this is a way that you could just really just set yourself up to walk out, especially small business owners today, even doctors. They no longer can sell their businesses for what they think. They end up being stuck with getting way less money than they thought they can even sell it at all. So the best thing to do is to be draining the assets down out of the plan, paying yourself first, and setting yourself up to be able to walk away with no pressure. Then you can sell it for whatever you feel like selling it, and you're not under any pressure to try to get it sold right away.
Wow. Really powerful. Tommy, you got anything else, buddy?
No, I'm still kind of floored. I know I've been working with Steve and Kathy on a couple of cases currently for a number of my clients, and the numbers that I'm seeing coming back from the actuaries, it's amazing. It's just I never thought that these specific clients could really put away the kind of money that this plan is going to let them put away, and it's really, when I look at it, sometimes I'm at a loss for words, and that doesn't happen often.
Yeah. And then again, too, Tom, you guys mentioned it earlier, that life insurance. Not only can that offer, a benefit down the road, but, what if life happens and, the client dies? Well, now the spouse has got a good amount of tax-free life insurance to help them going forward also. So
yeah, you've endowed your retirement, right? So no matter what happens, whether you make it to retirement, you become you die before retirement, you become disabled before retirement, that it's gonna work and it's gonna be there for you.
Yeah.
And your family.
Well, it could even be used in a buy-sell arrangement. You can have that there because if something happens to that principal, that beneficiary is going to be the family is going to get that money. They would then have the money to fulfill a buy-sell.
Yeah. There's just so many moving parts to this with so many great benefits. And, just for Tom had mentioned, I too have worked with Steve and his team. And, it's really as simple as us kind of running our clients through a questionnaire and then starting to get on a phone call with the client and the client's CPA. And as we've always talked about, right, not being an adversary, we're not trying to show the CPA how great we are or how smart we are. We are trying to work together to bring and deliver massive value to our clients.
Yeah, we like to say we're like a board of directors for the small business owner. We're all working together to make sure that everybody is doing the best we can for the client. We're helping them put away a lot of money. We're helping them prepare for retirement. We're helping them get tax deductions. We're helping them manage the money in a responsible under fiduciary standard. That's another thing about pension plans is they're set up. These plans are set up to put in large amounts of money so that you don't have to take market risk. It's based on low calculation. So if you're in a 40% tax bracket, for every dollar you're putting in, you're basically getting 40 cents contributed to you from the government.
Wow.
So, it's just so powerful to be able to put that kind of money away. You don't have to take the risk. That's what they're trying to define. They're trying to say, look, people get a little bit older and they go, I got to get more aggressive because how am I going to retire? And then we all know that as soon as you start to do that, the markets change on a dime and they clobber people. The risk reward just isn't there. So this is the opposite. It's saying, we'll give you tons of money. We'll give you large buckets of money to put in here to get a moderate return, somewhere in the 5-6% range is what it's being calculated on, in order to make sure that there's no risk taken so that the benefit is defined and will be there at retirement.
Those are old traditional pension calculation numbers. I mean, back in the 70s, 80s, before the psychos got in charge of the prison cells, those were the numbers that you had to utilize for your pension calculations. Nowadays, they use numbers like 7, 8, 9, which is just an unbelievable risk number that
right.
people should be taking.
You wouldn't be happy to talk about those state pensions now, are you, Tommy?
Not just the state.
Well, hey, Steve, thanks for coming on. And, although this is a complex topic, our job, Tommy and I's job, is to really help the clients understand in a simple fashion what we're doing. And Steve and his team are great at taking care of all the details. And like I said, he's a Brookstone advisor. So if you are a CPA and you have clients that you think this is perfect for, or you are a high-income business owner, give Tommy or I a call and let us help you out with this. Or heck, if you're living in the Las Vegas or Henderson, Nevada area where Steve lives and you need a great financial advisor, well, Steve's a Brookstone Capital advisor. And Steve, how can they contact you?
Well, they can reach me by phone 866-999-1332 or email me at steve@rasvcs.com.
Great. Well, hey, Steve, I appreciate you taking time from your busy schedule. And, today's tax day. So we're helping people out there, those business owners, reduce your bite that you're going to have to take on this day to day. So thanks again for coming on, Steve.
Thanks.
I appreciate it. Thank you, guys.
So, folks, that wraps up another great episode of the Retire Happy podcast. We hope you took away a lot of great information that Steve shared with us today. And Tom and I look forward to our next show where we will discuss asset protection with a PNC expert. Take care, folks.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-935-6210. That's 858-935-6210, or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623, and online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description or the show notes section of today's show for all that contact information. Don't forget to subscribe on your favorite podcasting apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iammarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot not be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered.